There are some people arguing that they needn't raise rates in December, but I think the combination of A, the signals they've sent, and B, the president's pressure, perversely, will mean that they pretty much have to raise rates this time. But I think people are watching very carefully what Jay Powell says at his press conference. I think Steve is right. This is a big test for him. Can he deliver a precise message that doesn't lock the Fed in too much, but doesn't make people think that that he doesn't know what he's doing? You mean doesn't lock the Fed into saying we will only raise once next year or something along those lines? I think what the Fed's trying to do is wean the markets off of forward guidance, and they're trying to be reasonably. It's uncertain what the outlook's going to be, what's happening to the rest of the world, what's going to the stock market and financial conditions going to be like in the next 6 months, what happens with the trade war. So they want to have flexibility. I think data dependent is their way of saying we're in a wait and see mode. But that's very hard to convey, especially when you have the dot plot where people want to know, is it going to be 2 rate hikes next year or 3? And he's going to try and say, we don't know. And the markets don't like hearing the Fed say, we're not sure what we're going to do. And we've heard data dependent before. It probably would have to be a new message to make the markets hear a different sort of resonance, saying that, OK, we are stepping away. We don't have the confidence we had a month ago or 2 months ago, based on the economic readings that we're getting at this point. Right. One thing that's really interesting is if you look at the Fed funds futures market, it looks like the market, that market is seeing very little chance of further rate increases in 2019. But when you talk to the analysts who follow the Fed closely, they're mostly thinking 2 rate hikes. So there's a bit of disagreement there. I think it has to do with the analysts predicting what they think the Fed is going to do, and the markets may be suggesting that they're more pessimistic about the outlook for the economy than the consensus at the Fed. Steve Leisman had this survey that we talked about yesterday, market participants that he spoke with. And the shocking thing that jumped out is maybe 12% of the respondents thought that we could actually see a rate cut come next year. What do you think of that? Right. I think that's reflecting some pessimism in the market about the outlook for the economy in 2019. I personally think that's overdone. I think Steve's right. The economy has a lot of momentum. It's surprisingly strong. The Fed does want to see the economy slow a bit. And the tricky thing is that this so-called soft landing is hard to pull off. You want it to slow a little bit, but not too much, and then you're vulnerable to something going wrong, whether in foreign policy or the markets or the craziness in Washington.
So that's just the unwavering faith that a hot market causes inflation eventually, right, David? I mean, it's weird to not. If you knew there wasn't going to be any inflation, to just want to slow it for no reason makes no sense. And you want wage pressure, for people, for income inequality.
Absolutely, and I think the difficulty the Fed is having now is the normal economic models would have suggested we would have seen more inflation now. So the question they have to ask is something really fundamentally changed, and we can run this hot economy for a lot longer without inflation, or is inflation just around the corner? That's always a really hard call, and it's particularly hard when you're under scrutiny from the political establishment and the markets are volatile.
David, how do you deal with the issue that the industry that seems to be getting hit the hardest right now is home building, in terms of the impact?
Well, I think what that tells you is home building is an interest rate sensitive industry, and mortgage rates have gone up a little bit. But, they have to look at the overall picture. Well, so that's one negative. That's clearly a negative, and a sign that financial conditions are indeed tightening, which means there's less urgency to raise the federal funds rate.
Do you think that the home buyer will adjust to the higher rate over the next 6 to 9 months, so that while the raise was great from where it was 2 years ago, all of a sudden he said, well, this is where it is, and it's safe, and I'm still going to have equity in something instead of paying just rent? Because if you look at demand right now for rental, it's very strong. It's very good. Housing starts go against the need for more housing in America. Housing stock is down. My question is, how much attention are they going to give to this very significant industry in America, which is probably more impacted than any other industry with a rate increase?
Well, I don't think that I think housing is important. It's an important channel for the way monetary policy works. But there's a lot of other things going on in the economy that they have to factor in. I think one thing we don't fully understand is how much the changes in the tax code that disadvantage housing home ownership, whether they're also contributing to the slowdown.
Well, I think there probably is some of that, but you don't get the deductions you used to get, particularly in the blue states.
Right. But also, as the bond market has backed off its predictions of what's going to happen to short-term interest rates, mortgage rates have actually fallen a little bit in the last couple of days.
I know.
So I think a lot has to do with how much confidence home buyers have that
Right.
in the economy, in their jobs, and whether rates will stay where they are. If they think they're going to go up, they might be more likely to pounce now.